It's a Tuesday morning. A man walks into a coffee shop. Not his usual stop, but today feels like a reason to celebrate. He just closed on his house. His name is on the deed, the mortgage, the whole thing. He owns it. He also drives a car he paid off 2 years ago, has a solid savings account, and genuinely does not waste money. This is not a story about someone who spends carelessly. This is someone doing everything right, by the rules most of us were taught. He orders something special, something he would not normally get on a regular morning. He pays, picks it up, walks back out to his car, and pulls away feeling like he has arrived. And honestly, by most people's measure, he has. Now look at the man sitting at the window of that same coffee shop. Nothing about him signals money. And if you ran his name through a basic financial check, you would find almost nothing attached to it. No property in his name, no car titled to him, no significant personal assets you could point to and say, that's his. On paper, he looks like he has less than the man who just walked out. But he just got off a call about his third property. He has a meeting later about a business acquisition. And that coffee? He did not even pay for it out of his own pocket. How? That is exactly what this video is about. Because this is not accidental, it is intentional. The rich do not avoid ownership, they relocate it. My name is Mila, and I am obsessed with the small moves and hidden nuances that build real wealth. And today, we are going to find out why the wealthiest people in this country own as little as possible in their own name. Because what matters to the rich is not ownership. It is control. Let's get into it. Here is something you need to understand before anything else in this video makes sense. Ownership and control are two completely different things. And the wealthy treat them that way. Most of us were never taught that distinction. We were taught that ownership is the goal. Your name on the deed. Your name on the title. Your name attached to the asset. That feels like safety. That feels like proof. But the moment your name is on something, that something is exposed. If you are ever sued, that asset is reachable. If you go through a divorce, it is on the table. If the IRS comes knocking, it is visible. Personal ownership and personal exposure are the same thing. Most people just never make that connection. The wealthy made it a long time ago. So instead, they focus on control. Rather than owning assets personally, they place them inside a separate legal entity. And what that means is this: in the eyes of the law, that entity is its own person. It is not you. It has its own identity, its own assets, its own liabilities. If something goes wrong, the legal claim lands on the entity, not on you personally. You are separated from the risk because legally, you and the entity are two different things. You control it, but you are not it. Now think about what that means in practice. You run a business and a client sues you. If everything is in your personal name, your home, your savings, your car, all of it is on the table. You go through a divorce. Everything attached to you personally is subject to division. You fall behind on taxes. The IRS moves against what you own. A contractor dispute, a liability claim. Any one of these situations, none of which make you a bad person, can reach straight into what you have spent years building and take a piece of it. Not because you did anything wrong, but because everything was sitting in your name, in plain sight, with no layer of protection between you and the claim. The wealthy do not leave their assets exposed like that. In the US, the most common structure they use for this is an LLC, and we will get into exactly how that works shortly. But before we do, you need to understand what that protective layer actually looks like, and why the wealthy are so deliberate about building it. Because it is not just one wall, it is a system of walls. Let me ask you something. Do you remember when O.J. Simpson lost that civil case in 1997 and was ordered to pay $33.5 million to the Goldman and Brown families? Most people remember the verdict. What most people do not remember is what happened next. The Goldman family spent years, literally decades, trying to collect that money, and they could barely touch him. His NFL pension, protected. His home in Florida, protected. The income he was still generating, structured in a way that made it extraordinarily difficult to reach. A man who owed $33.5 million was living comfortably. And most people looked at that and felt frustrated without understanding how it was even possible. It is possible because of structure. Now, before we go further, this video is not about protecting yourself from a judgment you deserve. It is about understanding that the tools O.J. Simpson's lawyers used are the same tools that every wealthy person in America uses to protect legitimate assets from unpredictable legal events. And those same tools are available to you. Here is the concept at the center of all of it: a financial firewall. And it works exactly the way it sounds. It is a structural barrier between different parts of your financial life, between your income and your assets, between your business and your property, between what you earn today and what you are building for tomorrow. If something goes wrong on one side of that wall, it does not automatically destroy everything on the other side. Most people have no firewall at all. Everything is connected to everything. Their income flows into a personal account. Their savings sit in their personal name. Their property is titled to them personally. Their business liabilities are their personal liabilities. It is all one pile. And one serious legal or financial event can set fire to the whole thing at once. The wealthy build walls between each of those things deliberately. A wealthy person might have one LLC that holds their real estate, a separate LLC that runs their business, another entity that holds their investments, and a holding company sitting above all of it, connecting everything together. Each entity is its own legal person. Each one is its own contained world. If the business gets sued, the real estate is not touched. If one property has a liability issue, the others are not affected. The risk stays exactly where it started. So let us talk about the LLC for a moment, because we have mentioned it enough times that you deserve a real explanation. LLC stands for Limited Liability Company. It is a legal business structure that exists separately from you as a person, which is exactly the separate legal entity concept we talked about earlier. It has its own identity in the eyes of the law. It can own property, hold assets, run a business, and collect income. And because it is legally separate from you, claims against the LLC do not automatically become claims against you personally. Now, here's the part that surprises most people. You do not need to be wealthy to form one. In most U.S. states, you can set one up for a few $100s. It does not require a team of lawyers or a $1 million portfolio. It requires a decision and a little paperwork. The wealthy are not using a tool that is unavailable to you. They are just using a tool that most people did not know existed. But here is what makes this even more powerful. And this is where most people's understanding stops short. The firewall does not just protect you from lawsuits, it also controls when and how you are taxed. In 2018, Amazon reported over $11 billion in profit. Their federal income tax bill? Zero. Legally. Not because they were hiding money, because they understood something most people do not. Tax is not just about how much you earn. It is about how your earnings are structured and when they become taxable. Inside a properly structured entity, money can be reinvested, timed, and distributed in a way that gives you control over your tax exposure. The same income that would be taxed immediately in your personal name can sit inside a structure, working and compounding, before it ever triggers a personal tax event. Same money, completely different outcome. This is not complexity for the sake of complexity. Every wall exists for a reason, every separation has a purpose, liability on one side, tax efficiency on the other, and the person at the top, controlling all of it, is sitting behind a structure that most people did not even know they could build. One fire should never burn down the whole house. That is what the firewall is for. And this is the mindset shift that makes everything we are about to show you actually land. The wealthy stopped asking, "What can I own?" They started asking, "How can I control it without owning it personally?" And nowhere is that more visible than in how they handle income. Let us take two people, both earning $100,000 a year. Same income, same country, same tax system, completely different financial reality. Person A earns that $100,000 personally. It hits their bank account and the IRS is already waiting. Federal income tax kicks in immediately. State tax follows. By the time they see what is left, a significant portion is already gone. They did not get a say in the timing. They did not get a choice about when it became taxable. The money arrived, the tax bill arrived with it, and now they work with whatever remains. Person B earns that same $100,000 through an entity. The money lands inside the business first. Before it ever becomes personal income, the business covers its legitimate expenses. Equipment. A vehicle used for business travel, a home office, professional services, software, travel. These are not luxuries. They are real costs of running a real operation. And because the business covers them before profits are calculated, the taxable income is already lower, before person B has taken a single dollar personally. Then comes the part that changes everything. When person B decides to actually take money out, they choose when, they choose how much, they choose the method. A salary just large enough to satisfy payroll tax requirement. Distributions time to avoid pushing into a higher tax bracket. Reinvestment back into the business before it ever becomes personal income at all. Same $100,000. But person B is making decisions that person A never even knew were available. This is what people mean when they say the wealthy pay less tax. It is rarely about paying nothing. It is about timing. It is about the gap between when money is earned and when it becomes personally taxable, and using that gap deliberately. Think about what that gap actually gives you. You can smooth income across years so you never spike into the highest brackets unnecessarily. You can reinvest before tax inside the entity, so the money compounds on a larger base. You can build retained earnings inside a structure that keeps working while your personal tax bill stays controlled. Same money, same rules, completely different outcome. The difference is not luck. It is not connections. It is not a secret available only to people with expensive accountants. It is a system. And the system starts with one decision. Stop letting income land in your personal name before you have had a chance to direct it. At this point, you are probably sitting with one very reasonable question. If the wealthy own almost nothing personally, if the house is in an LLC, the car is in an LLC, the business is in an LLC, how do they actually live? How do they pay for dinner? How do they take a vacation? How does any of that money actually reach them? That is exactly the right question. And the answer is where this whole thing comes together. Let us go back to the man at the window of that coffee shop. The one with almost nothing in his personal name. The one who just got off a call about his third property and had his coffee covered by rental income. You have been watching him this whole video and wondering, how? How is the money moving if it is not sitting in his personal account the way it sits in most people's? Here is how. The wealthy do not think about money the way most people do. Most people think about income as something that arrives and then gets divided. Some goes to tax, some goes to bills, some goes to savings if there is anything left. Linear, passive, the money lands. And then you manage what remains. The wealthy think about money as something that moves through a system. And they design that system deliberately. The money does not just arrive, it enters a structure, gets directed, gets put to work, and then comes back to them in a form they chose, at a time they chose, in a way that costs them as little in tax as possible. That system has 3 main channels, and the best way to understand all 3 is to watch them in action. Meet Danielle. She runs a consulting business through an LLC and brings in $150,000 in revenue over the course of the year. Before that money ever touches her personally, the business covers its legitimate expenses. Her laptop, her software subscriptions, client travel, professional development, and here is one worth pausing on. Her home office. If you use a dedicated space in your home exclusively and regularly for business, a proportional share of your rent or mortgage qualifies as a legitimate business expense. So, if your rent is $2,000 a month and your home office takes up 15% of your home, $300 of that monthly rent is a real deductible expense, not your entire rent. The IRS is very clear about that, only the genuine business proportion. The moment you try to run purely personal living costs through your LLC, you are blurring the lines that keep your structure legally intact. So be accurate, be proportional, and document everything. Back to Danielle. By the time her legitimate business expenses are accounted for, her taxable profit sits at $100,000. She did not hide anything. She did not bend any rules. She simply ran a real business, and the business had real costs. Now she decides how to move that $100,000 through the 3 channels. The first channel is salary. She pays herself $40,000 for the year, enough to satisfy IRS payroll requirements, enough to keep her Social Security credits building, not a dollar more than necessary, because every extra dollar of salary is taxed as ordinary income immediately. The salary is not where she lives. It is where she complies. The second channel is where the real income lives. The remaining $60,000 in profit she takes as a distribution. And here is where the numbers get interesting. That same $60,000 taken as ordinary personal income can create a tax burden closer to 37% once you combine federal income tax and self-employment tax. That is approximately $22,200 gone before she sees a dollar of it. But taken as a qualified distribution in a setup like this, that rate can fall closer to 15%. That is $9,000 in tax on the same $60,000, a difference of over $13,000 on one decision in 1 year. She chose the form, she chose the timing. The IRS got what it was owed, just not a penny more than that. These figures will vary depending on your state and your situation, but the principle holds everywhere. The third channel is retained earnings. That final $20,000, she leaves it inside the LLC entirely. It does not become personal income at all this year. It goes straight toward the deposit on her next investment property. It compounds on a full $20,000 base, not on whatever would have been left after personal tax took its share. The money keeps working before it ever becomes hers on paper. Now, here is where it gets real. Compare Danielle to someone who earned the exact same $150,000 personally. No structure, no entity, no channels, no choices. Federal income tax hits the moment it lands. State tax follows. Self-employment tax on top of that. By the time they see what is left, they have lost somewhere between $45,000 and $52,000 to tax, with no say in the timing, no ability to reinvest before tax, and nothing retained inside a structure still working for them. Danielle's total tax bill could land somewhere around $18,000 to $19,000. The person with no structure, between $45,000 and $52,000. Same $150,000. Same year, same country, same tax system. A gap of approximately $27,000 to $37,000 from one decision about structure. But here is what I really want you to sit with. That gap does not stay the same as income grows. It multiplies. At $500,000 a year, someone earning personally loses approximately $180,000 to $185,000 in tax. Someone earning through a properly structured entity pays approximately $97,000 to $108,000. The gap is now between $75,000 and $90,000 every single year. At $1 million a year, someone earning personally loses approximately $350,000 to $370,000 in tax. Through a structure, approximately $200,000 to $245,000. The gap is now between $110,000 and $170,000. Annually, on the same income, this is not a rounding error. This is not a technicality. This is why the wealthy are obsessed with structure. Because at scale, the difference between having it and not having it is not thousands of dollars lost every year. It is life-changing money left on the table every single year and compounding against you for decades. Now, before we move forward, if you are a salary earner, you might be sitting there thinking this does not apply to you. And I want to be honest with you about that because you deserve a straight answer. If your only income is a W-2 paycheck from an employer, you cannot run that income through an LLC. The IRS does not allow it. So the distribution strategy and the income timing we just walked through, that specific advantage is not available to your salary directly. But here is what is available to you right now. First, asset protection. And anyone can place assets inside an LLC regardless of how they earn their income. If you own property, have investments, or are building anything outside of your job, you can put a protective structure around it today. Your salary earner status does not change that. Second, and this is the one I want you to sit with, most salary earners are not only salary earners forever. You have freelance work, a side business, a rental property you are thinking about, a skill you could monetize. The moment any of that exists, this entire framework becomes directly relevant to you. And the people who win are the ones who understand the structure before they need it, not after. The wealthy do not build these systems when they are already rich. They build them early, when the stakes feel low and the cost of setting it up is small, so that by the time the money gets serious, the structure is already in place. That is the move. So now you understand how money flows through a structure. But here is the next question the wealthy ask, and it is one most people never think to ask at all. What happens if one part of the structure fails? Because here is the thing. The wealthy are not naive. They do not build structures because they believe nothing will ever go wrong. They build structures precisely because they know something eventually will. A business that underperforms, a property with a liability issue, a partnership that sours, a lawsuit from a tenant, a client, a contractor. These are not worst-case scenarios reserved for unlucky people. These are normal events in the life of anyone building something real. The question is, never will something go wrong. The question is, how much of everything else does it take down with it when it does? And the answer, if you have built correctly, is almost nothing. Here is how they do it. Instead of placing everything inside one entity, the wealthy isolate risk by separating each asset or business line into its own structure. One LLC for each property, a separate LLC for the operating business, another entity for investments. Each one is its own contained world with its own assets, its own liabilities, and its own legal identity. What happens inside one entity stays inside that entity. It does not automatically travel to the others. Think about what that means in practice. Say our man from the coffee shop owns 3 rental properties. If he holds all 3 inside one LLC and a tenant in property one sues him successfully, all 3 properties are potentially exposed. They are all sitting in the same legal basket. One claim reaches all of them. But if each property sits in its own LLC, property 1, property 2, property 3, each in a separate entity, that lawsuit lands on the LLC that owns property 1. Property 2 and property 3 are untouched. Different entity, different legal person. The fire stays in the room where it started. Same properties, same lawsuit. Completely different outcome depending on how the structure was built. And this is not just about lawsuits. It is about how the wealthy think about risk as a design problem. They do not manage risk emotionally, hoping things work out, crossing their fingers, assuming the good years will outweigh the bad. They manage risk architecturally. They build the structure so that even when something goes wrong, and something always eventually does, the damage is contained, the other assets are protected, and the system keeps running. One failure does not become total loss. That is the design. Now you might be wondering, does this not get complicated? Multiple LLCs, multiple structures, multiple sets of paperwork? And the honest answer is yes, there is administrative work involved. There are filing fees. There are separate bank accounts to maintain. There are lines you have to keep clean between each entity. Because the moment you start blurring those lines, using one entity's account for another entity's expenses, mixing personal and business finances, while treating the whole structure like one big account with different labels, you start quietly dismantling the protection you built. The legal term for when a court decides your LLC is not actually separate from you is piercing the corporate veil. And when that happens, the separation disappears, the protection disappears, and suddenly, everything you thought was isolated is exposed again. The wealthy understand this, which is why they treat each entity like a real independent business. Separate bank accounts, clean records, proper documentation, not because they enjoy paperwork, but because the paperwork is what makes the protection real. The structure is only as strong as the discipline behind it. And here's the final thing to understand about risk isolation. It is not just about protecting what you have today. It is about giving yourself permission to take calculated risks tomorrow. When you know that one venture failing cannot take down everything else you have built, you make bolder moves. You invest more confidently. You are not paralyzed by the fear of losing everything because everything is not sitting in one exposed pile waiting to be reached. That is the quiet confidence you see in wealthy people when they talk about business. It is not arrogance. It is architecture. They know exactly how much any single failure can cost them. And they built the structure so that number is always manageable. Now, here is what nobody tells you when they explain how all of this works. The structure is only as powerful as the decisions you make inside it. And there are 2 specific moments where most people quietly hand back every protection they just built, without realizing it. The first one is the personal guarantee. You set up your LLC, you feel protected. And then you go to get a loan for a property or sign a commercial lease for your business, and the lender or landlord asks you to sign a personal guarantee. And because you want the deal, because everything else is in place, because it feels like a small formality, you sign it. That signature just collapsed your structure. The moment you sign a personal guarantee, you are telling the lender, if this entity cannot pay, I personally will. Your LLC is no longer a separate legal person for that debt. You are. Your personal assets are now standing behind that obligation regardless of how cleanly your structure was built. The firewall you spent time and money creating has a hole in it, exactly the size of that signature. The wealthy understand this, which is why they fight personal guarantees hard. They negotiate around them using the company's track record, the entity's assets, or the backing of a holding company instead of their personal name. And when a personal guarantee is truly unavoidable, they negotiate limits. They cap the exposure. They get it in writing exactly how much of their personal world is on the line, and they make sure it is as small as possible. Before you sign anything, a lease, a loan, a finance agreement, ask one question. Is this in my name or the entity's name? That single question is worth more than almost anything else in this video. The second place the structure breaks down is quieter, and it catches more people than the personal guarantee does. It is the slow blurring of lines between your personal finances and your business finances. It starts small. You forget your business card, so you use your personal one. You run a personal expense through the company account because it is easier. You transfer money between your personal account and your LLC without documenting it properly. None of these feel like big deals in the moment, but each one is quietly weakening the wall. Because if you are ever audited, sued, or legally challenged, the first thing anyone looks for is whether your LLC is actually a separate entity or just you with a different account name. They look for commingled funds. They look for personal expenses run through the business. They look for a lack of documentation, contracts, and proper records. And if they find those things, they can make the argument that your LLC was never truly separate from you at all. That argument has a name: piercing the corporate veil. And when a court agrees with it, your personal assets are exposed. Everything you structured to protect yourself is suddenly on the table. Not because the structure was wrong, because the discipline behind it was not there. The wealthy treat their entities like real independent businesses. Separate bank accounts, clean paper trails, proper documentation for every transaction. Not because they enjoy administration, but because the administration is what makes the protection legally real. The structure is the wall. The discipline is the mortar. Without both, the wall does not stand. Before we get into where you start, one honest thing worth saying. The wealthy do still own some things personally. Retirement accounts like a 401k or a Roth IRA, a home they choose to enjoy. Lifestyle assets that are genuinely personal. The point of everything we discussed today is not to own nothing. It is to be selective and intentional about what carries your name, because the difference between the wealthy and everyone else is not that they own less. It is that they think carefully about what belongs in their personal name and what belongs in a structure. That distinction, made early and made deliberately, is what changes everything. So let us bring this all the way home, because everything we have covered today, the separation of ownership and control, the firewall, the 3 channels, the risk isolation, none of it means anything if it stays theoretical. The point is not to understand how the wealthy think. The point is to start thinking that way yourself. So here is where you actually begin. The first thing you need to do is audit what you currently own personally. Sit down and write it out: your property, your car, your savings, your investments, anything attached to your name. This is your exposure map. This is everything that is currently sitting in plain sight with your name on it. You are not doing this to panic. You are doing this to see clearly, because you cannot build a better structure until you know exactly what is exposed right now. The second thing is to identify what you are building outside of your job: a side business, freelance income, a rental property you are considering, an investment account growing in your personal name. Any of these are candidates for a structure. Any of these represent a place where an LLC could separate you from the risk and give you options you do not currently have. The third thing is to stop waiting until the money gets serious. This is the mistake most people make. They tell themselves they will set up the structure when they have more to protect. But the wealthy do not build the structure after the wealth arrives. They build it early, when the stakes feel low and the cost of setting it up is small, so that by the time the money gets serious, the walls are already standing. In most states, you can form an LLC for a few $100s. The cost of not having one when you need it is infinitely higher. And the fourth thing, get the right advice for your specific situation. This video is about the framework, the principle, the way of thinking, on your actual structure, how many entities you need, how to set them up, how to move money between them compliantly. That requires a CPA, and ideally, a business attorney who understands asset protection. The wealthy do not figure this out alone. They build a team. And that team is not a luxury. It is part of the structure. Those are your 4 starting points. Not a 10-year plan, not an overnight transformation. Just 4 honest next steps that move you from personally exposed to structurally protected. Now, let us zoom out for a moment. Remember the man who walked into that coffee shop on a Tuesday morning, celebrating a house with his name on the deed, a car he paid off, savings he built carefully, doing everything right by every rule he was ever taught. There is nothing wrong with that man. He is disciplined. He is intentional. He deserves everything he has built, but he is exposed in ways he cannot see. And the vulnerability is not in his character. It is in his structure. And the man at the window, the one with almost nothing in his personal name, the one whose coffee was covered by rental income, the one who looked like he had less. He is not smarter. He is not luckier. He did not have access to tools that were unavailable to the first man. He just learned something earlier. That wealth is not about what you own. It is about what you build around what you own. Ownership is visible. Structure is invisible. And invisible is exactly where the wealthy want their assets to be. That is the game. And now, you know how it is played. If this video gave you a new way of seeing how money actually works, share it with someone who needs to hear it. And if you are not subscribed yet, join us here. Because this is exactly the kind of conversation we have every single week. And always remember, luxury is easier when your money is organized. I will see you in the next one.